let's welcome our guest editor for the day. Nilesh Shah, Managing Director and CEO, Envision Capital, has walked into the studio. Thank you very much, Nilesh, for joining us today.
Thank you, Lata.
Well, there are people other than us who are very happy that you have joined, because the market has greeted you with a very big good news. Moody's, as you would have read, has upgraded the outlook on India's rating to positive. You told us in some of the notes that you sent to us before that you see a Goldilocks scenario for India. So Moody's are echoing your views, you think?
Well, this is perhaps, the best possible kind of scenario that India could be in. We've really come out of some very difficult times. And I think the foundation of this bull market has been laid about 18 months back, where we kind of went in with aggressive policy response. When inflation was really high, deficits were high, growth was really not happening, it was very sluggish. And I think from there on, the policy response, the political mandate, and of course the crash of crude, I think all three have been very, very big factors which have at least in a very big extent receded the headwinds which India was facing. So clearly concerns on inflation, deficit, I think those are no longer concerns. Clearly now the big opportunity and the big challenge is to basically revive growth. And that's what we actually believe, that going forward, India gets into a situation of a pretty strong economic growth with very stable inflation outlook and relatively low deficits. And therefore I think clearly India's macros are clearly amongst the best over the last few years. And
is this an 18-month outlook? Is it a 24-month outlook, or is it a 5-year outlook?
I think this is going to be a much longer outlook. I think this is probably a scenario which could prevail for many, many years. The fact that clearly there is an aspiration, to take India from a $2 trillion economy to a $20 trillion economy over the next, many years or even a few decades. And I think if a lot of reform initiatives which have already been outlined are actually executed with a lot of seriousness and with the right earnest, clearly you would actually see India doing extremely well in this scenario playing out for many, many years. I don't think this is something which is going to play out for a few months or a few quarters. Actually, the risk is that you might actually not see this play out for the next few months.
You'll have to perhaps wait longer.
Absolutely. But I think clearly from a 3-year, 5-year, 10-year perspective, I think this is a scenario which will probably likely play out now.
That's the thing, right, Nilesh? I mean, everyone, first of all, good morning and thank you for joining us. Everyone's betting on proper execution of these reforms. So far, reforms have been announced, whether it's the coal auction, whether it's things on the real estate front, etc. But in your mind, what is crucial as far as execution is concerned? List down those 1, 2, and 3 legislative agenda that the government has put forth, which is critical for it to, be executed properly.
I clearly believe India is very fortunate that we have, of course, our 2 very big economic drivers which continuously play out irrespective of whichever government is in power, which is clearly demographics and, urbanization. These 2 are very big drivers. But clearly the growth accelerators, what India really needs are not just structural growth enablers or drivers, but we need growth accelerators. And clearly, I think the biggest focus area has to be infrastructure. I clearly believe a lot of the future prospects of India are linked to infrastructure gathering momentum. Private investment in infrastructure could still take some more time, but I clearly believe public investment needs to kickstart and kickstart really fast. I clearly believe that's one big agenda which should be there. The second big economic agenda has to be GST. I mean, we've clearly seen, of course, successive budgets lay down a time frame and a timeline to kickstart GST. But I think GST itself can do wonders for India as a nation, India as an economy, of unifying India as a market. Third, of course, is this whole JAM initiative, which is this Jan Dhan, Aadhaar, and this mobile, where you basically have direct transfers happening of subsidies, and that's a huge number, because on a $2 trillion economy, subsidies account for 2%, which is clearly runs into $100 billions. I think potentially, theoretically, assuming all of that money which flows into the families, especially of people who stay below the poverty line, you could have 30,000-40,000 rupees per annum flowing into a family of 4 or 5. Now that's huge. And that in itself could kickstart demand. It could take in a lot of millions of individuals and households into the consumption mainstream, which could basically kickstart demand for a lot of consumer staples, small ticket appliances, and many other things. So I don't think spending would just be on the traditional roti, kapda, makan, but many more things. So I clearly believe these three big initiatives, which is infrastructure investment, GST and JAM, I think are three very powerful growth accelerators, which India already has, which have already been identified, to some extent started, but probably need to be executed with a lot more vigor and with a much stronger intent. I think the outcomes of that could be virtually miraculous.
So how would you play it? Would you play the infrastructure themes, the Coal Indias, the various power companies, or the road companies? Or would you play the ultimate beneficiaries when roads are up and about, the consumption themes? What would you play?
Probably it will have to be a combination of both. We're very fortunate in India that we have a very large universe of listed companies, so many sectors. We're not like a market like, say, maybe Korea, where there's probably some semiconductor players, and Taiwan, and we're not like that. We are far
certainly
more,
one car company.
Exactly. So we are far more broad-based, and I think that's really the good news. And there's lots to pick and choose from. Maybe so far one has clearly been more on the defensive side, play out the consumers, play out the financials. Probably you've been better off avoiding the infrastructure names. But I think going forward, it will have to be a balanced mix of the both. Quite possible that over the next 1 or 2 years, clearly some of the automobile companies are going to benefit a lot. Financiers to automobile players, financiers to commercial vehicle players, I think they will benefit a lot. Clearly believe that real estate is going to be a very big contrarian play. Clearly that's been a sector in the dumps, but so much is happening. Interest rates are falling. Demand could potentially revive. A lot of regulatory changes are happening. So I think that's one big sector. And then, of course, are going to be the infrastructure service providers, which basically, of course, who are going to take on road projects, power projects, and all of that, provided, of course, they're very conscious of the capital allocation and are relatively more efficient and don't go out and burn capital and create holes in the balance sheet. So I clearly believe it's still time to still stick to quality, but you probably need to get a lot more broad-based than what one has been in the last 2 or 3 years.
In your assessment, what is the correlation between or among market growth of falling interest rates and rising GDP?
I think there is a clearly strong correlation. I think, of course, the empirical evidence of a lot of developed markets has suggested that there's really no correlation. I mean, classic case is the US, where you see the last 5 years, economic growth rate has not been there, 1-2%, but look at what the markets have done. But clearly, I think in a country like India, that's very relevant. And if you really look at slightly more long-term data, so if you were to kind of look at the data from where economic reforms have got unveiled, say from 1991, since then, EPS growth for Sensex companies has been about 15% annualized. Yeah? Versus that, the Sensex returns, excluding dividends, have been about 15 to 16% annualized. So it's very, very strong. So maybe there is not a strong correlation between GDP growth and Sensex returns, but clearly there's a very strong correlation between EPS growth and the Sensex returns. And a lot of EPS growth definitely comes in from economic growth, because we're not yet a developed nation. We are a developing nation. We're a rapidly growing economy. And I think in that environment, there would definitely be a strong correlation between the GDP growth and earnings. We also have a whole host of leveraged companies. So clearly falling interest rates boost margins.
So what's the expectation from here on?
I think it's a very interesting analogy, because if you really look at, again, these last 20 years, India gets into these periods where for 5 years, we kind of grow at 20, 25, 30%. And then for 7, 8 years, because of lack of reforms, tough global conditions, we get back into single-digit earnings growth. Okay, so the last 7, 8 years, from say 2008 to 2015, our annualized EPS growth rate has been about 7, 8%. But prior to that, it was about 25% for 5 years. Clearly, conditions have turned a lot more benign. Clearly, the Goldilocks situation which India is facing or is having or enjoying right now, where undercurrents are very strong, I think we could get back into at least a 20% earnings growth over a 5-year time frame. It's not going to start from the first or the second quarter of the next financial year, but over a 5-year period, we can get into that 18 to 20%. But even if we don't get back to 20%, but even if we get to 15%, I think that's going to be excellent. That's going to be fantastic by any stretch of imagination.